You've probably heard this advice everywhere. Just invest in index funds, hold long term, and you'll be fine. And honestly, that's still one of the smartest and simplest strategies out there. But here's the part nobody talks about. While most investors were quietly earning 10 to 15% per year in broad market ETFs, a smaller group was positioning themselves in specific sectors that were compounding at a completely different level. Same market, same time period, completely different results. This isn't about gambling on crypto or picking random stocks. This is about understanding where real growth happens inside the market. In this video, we're going to rank 9 powerful ETFs from stable to aggressive, not just based on returns, but based on the deeper reason why they performed the way they did. Because once you understand the why, you stop copying strategies and start thinking like a smart investor. Before we begin, there's one rule you need to lock into your mind. Past performance does not guarantee future results. These rankings are not predictions. They are patterns. They show where capital flowed, which sectors dominated, and where long-term structural growth existed. Your job is not to blindly copy these ETFs. Your job is to understand the logic behind their performance. Because markets change, but the forces driving them, innovation, demand, human behavior, tend to repeat. If you can understand those forces, you can position yourself ahead of the curve. At the bottom of the list, we start with global diversification. This type of ETF invests in companies outside the United States, Europe, Asia, and emerging markets all combined into one basket. It gives you exposure to thousands of businesses across different economies and currencies. The idea is simple. Don't depend on one country. Over the last decade, these ETFs delivered steady but lower returns compared to US markets, mainly because the US dominated global growth during this period. But the hidden strength here is protection. If the next decade shifts toward international growth, this category becomes extremely important. It may not be exciting, but it acts as insurance in a portfolio. Next is the total world market approach. Instead of choosing between US and international markets, this ETF owns everything. It reflects the global economy as it exists today. If US companies grow faster, they automatically take a larger share. If other regions start outperforming, the balance shifts on its own. Over time, this creates a naturally adapting portfolio without the need for constant adjustments. The returns here have been solid and consistent, even if they didn't lead the charts. The real value is simplicity. One investment, global exposure, and automatic rebalancing make it ideal for long-term investors who prefer a hands-off approach. Moving forward, we come to dividend-focused ETFs. These are built around companies that generate strong cash flow and return part of that cash to investors in the form of dividends. These companies are usually mature and stable, operating in industries like energy, telecom, and consumer goods. The key difference here is that you're not relying only on price growth. You're also getting paid regularly. Over the last decade, these ETFs delivered respectable returns with lower volatility. During market downturns, they tend to fall less because cash-generating businesses are more resilient. This makes them attractive for investors who value stability and income over aggressive growth. Now we step into the total US market. This ETF includes every publicly traded company in the United States, large, mid, and small cap businesses. It gives you exposure to the entire economic engine of the country. While large companies provide stability, smaller companies offer the potential for future growth. Over the last decade, the US led global innovation, and this ETF captured that strength. It slightly underperformed large cap focused funds, but it provided broader exposure. Think of it as owning the full system, rather than just the biggest players. Then comes the benchmark most people know, the S&P 500. This ETF tracks the 500 largest companies in the US, companies that dominate their industries. What makes it powerful is its structure. It constantly evolves. Underperforming companies are removed and replaced by stronger ones. This means you are always invested in the leading businesses of the time. Over the last decade, it delivered strong returns with extremely low fees. It's simple, efficient, and proven. And yet, it still doesn't rank at the top of this list, which tells you something important. There are strategies that go beyond just holding the market. This brings us to momentum-based ETFs. These funds don't just hold companies, they select them based on performance trends. They focus on stocks that are already moving upward, based on the idea that winners tend to keep winning for a period of time. These ETFs regularly rebalance to stay aligned with current leaders. Over the past decade, momentum strategies delivered higher returns than traditional index funds. But there's a trade-off. When market trends reverse, these ETFs can drop quickly. It's a strategy that rewards discipline, but punishes emotional decisions. Next, we move into growth-focused ETFs. These are heavily concentrated in sectors driving the modern economy: technology, digital platforms, innovation-driven companies. Instead of spreading investments evenly, they focus on where the future is being built. Over the last decade, innovation accelerated rapidly, and these ETFs captured that wave. The returns were significantly higher than the broader market. But concentration comes with risk. When growth slows down or sentiment shifts, these funds can become volatile. This category rewards long-term belief, but requires patience during downturns. Taking it a step further, we have pure technology ETFs. These remove everything except core tech companies' software, hardware, cloud infrastructure, and digital systems. These funds are essentially a direct bet on technology dominating the global economy. Over the past decade, that bet paid off massively. Technology became the backbone of nearly every industry, from finance to healthcare to entertainment. These ETFs delivered exceptional returns, driven by a small number of dominant companies. But with high concentration comes higher volatility. When tech rises, these funds surge. When it falls, they can drop sharply. At the top of the list, we reach the most powerful and most volatile category: semiconductor ETFs. These focus on companies that design and manufacture chips, the foundation of all modern technology. Every device you use, every system that runs the digital world, depends on semiconductors. Over the last decade, demand for computing power exploded, driven by artificial intelligence, cloud computing, and advanced electronics. As a result, these ETFs delivered extraordinary returns. But this level of growth comes with intense volatility. These funds can rise quickly, but they can also fall hard during market corrections. So what's the real takeaway? It's not about chasing the highest return. It's about understanding why those returns happened. Broad market ETFs provide stability, diversification, and long-term reliability. Sector-focused ETFs offer higher growth, but come with higher risk. The smartest investors combine both. They build a strong foundation with diversified funds and then add targeted exposure to high-growth areas. That's how you balance risk and reward effectively. At the end of the day, investing is not about finding the perfect ETF. It's about building a system you can stick with over time, because the real power of investing comes from consistency and compounding. The difference between average and extraordinary results isn't luck. It's understanding, discipline, and the ability to stay invested when it matters most.